The Pacific Northwest once felt almost immune to downturns, not because it was cheap, but because it felt distinctive. Buying there was about more than property. It was about scenery, lifestyle, and atmosphere. People paid for mountain views, forest roads, rainy streets, quiet suburbs, strong tech jobs, bike trails, lake weekends, cozy cafes, and a life closer to nature. Seattle stood for high-paying tech careers. Portland was known for creativity and culture. Bend attracted outdoor lifestyle seekers. Spokane offered relative affordability. Boise represented a fresh start. Together, these places created a strong belief that Northwest real estate might slow but wouldn't truly fall. Buyers overextended, expecting prices to rise if they waited. Sellers held firm, convinced demand would always return. Investors followed growth, remote work, and lifestyle demand into markets that seemed protected by their appeal. By 2026, that confidence has started to weaken. Homes that once sold in days now linger on the market. Competitive bidding has cooled. More families are choosing to rent instead of stretch their budgets. Some tech workers are delaying moves, and certain investors are exiting early to limit losses. Instead of sudden crashes, the slowdown appears gradually, market by market, until it becomes impossible to ignore. Today on Discover the Cities, we're exploring 10 Pacific Northwest cities where the housing market is losing momentum in 2026. Number 10. Spokane. Spokane's housing growth was driven by one straightforward strength. The numbers worked. For many years, it stood out as a practical option. When buyers in places like Seattle, Portland, and across California faced overwhelming prices, Spokane presented a more attainable alternative. It was a genuine metropolitan area with lower home costs, larger properties, and calmer neighborhoods. The city had enough employment opportunities, medical centers, universities, and everyday services to feel secure and functional, yet it didn't carry the extreme expenses seen along the coast. That balance is what fueled its rapid expansion. People weren't relocating there for prestige or status. They moved because, financially, it made logical sense. Families could upgrade to more living space. Remote employees could leverage coastal-level incomes in a cheaper market. Retirees could sell in higher-priced regions and downsize into something quieter and less stressful. Investors also saw opportunity, since rental prices still appeared reasonable compared to many Western markets. For a time, Spokane was viewed as one of the final places in the Pacific Northwest where buying a home still felt achievable. In 2026, however, that edge has weakened. The median home price is currently around $350,000 and is slightly lower than it was the previous year. But the small drop in price is not the central concern. The larger issue is that values remain far above pre-pandemic levels, while local wages have not increased at the same speed. That imbalance is creating pressure in the market. A home that once felt affordable now comes with a noticeably higher monthly cost. At the same time, mortgage rates, property taxes, insurance premiums, utility bills, maintenance expenses, and overall inflation are affecting buyers all at once. As a result, behavior is shifting. Open houses no longer feel rushed or competitive. Buyers are making more cautious offers. Properties that would have sold quickly during the market surge now require accurate pricing, strong presentation, and greater patience from sellers. Spokane continues to be one of the key inland cities in the Northwest region. Still, its primary strength was always affordability. When that advantage begins to weaken, there is less flexibility in the market. In 2026, Spokane is no longer just the budget-friendly option. It is becoming an example of how even value-driven cities can experience decline when housing costs outpace what residents can comfortably afford. Number 9. Bend. Bend's rise in price was never just about real estate. It was about lifestyle. Buyers weren't simply purchasing homes. They were investing in access to outdoor living. They were paying to live close to hiking trails, ski areas, local breweries, wide-open desert landscapes, dramatic mountain views, and a pace of life that felt calmer and more purposeful than in larger metropolitan areas. When the pandemic-driven housing surge began, that lifestyle became especially desirable. Buyers moved in from high-cost regions such as California, Seattle, and Portland, bringing substantial budgets and different expectations about home values. Some were searching for vacation properties. Others wanted a full-time relocation that felt like a permanent reset. Many remote workers viewed the scenery itself as part of their compensation, treating the environment as a benefit tied to their job. That influx of outside wealth elevated Bend into a new tier. It stopped being viewed as just another Central Oregon town, and instead became known as a lifestyle-driven market with premium pricing. Now, in 2026, that premium is facing pressure. The median sale price has declined to around $681,500, which is nearly 8% lower than it was last spring. In certain neighborhoods, properties are remaining on the market for nearly 2 months. For a city that once relied on urgency, limited inventory, and emotionally driven demand, this shift represents a noticeable slowdown in pace. Despite these changes, Bend has not lost its natural appeal. The mountains still dominate the horizon. The trail systems continue to attract residents outdoors. Local breweries remain popular gathering spots on weekends. The visual charm and recreational advantages are still very much present. The postcard image of Bend has not disappeared. What has changed is buyer behavior. People are no longer overlooking the full financial commitment involved in ownership. They are carefully evaluating monthly mortgage payments, property taxes, insurance costs, ongoing maintenance, winter-related expenses, wildfire exposure, and how far home prices have already climbed. This careful approach matters because housing in Bend has long been out of reach for many local professionals. Teachers, healthcare workers, restaurant staff, service employees, and small business owners often struggle to afford homes in the same market they help sustain. When strong outside demand was driving prices upward, that gap was less visible. As demand cools, the imbalance becomes more obvious. Bend is not losing its scenery, its culture, or its desirability. What it is losing is some of the extreme pricing momentum created during the boom period. In 2026, the reality is straightforward. The lifestyle remains attractive, but buyers are no longer willing to pay unlimited premiums for it. Number 8. Tacoma. Tacoma has never been just a lower-cost alternative to Seattle. It is a port city with its own identity, shaped by industry, history, distinct neighborhoods, older architecture, waterfront scenery, and a mix of blue-collar heritage and urban character. Still, its housing market benefited from one undeniable reality. Seattle prices became out of reach for many buyers. As costs in King County climbed higher and higher, people began looking south for more affordable options. Tacoma naturally emerged as the next serious choice. It provided larger homes, lower price points, properties with personality, and enough restaurants, culture, and city energy to feel like a destination rather than a compromise. That shift generated strong demand. Families stretched their budgets to move there. Investors entered the market. Areas that had previously received little attention started gaining momentum. Homes that once lingered on the market became part of the broader Puget Sound affordability narrative. However, by 2026, Tacoma's pricing story is not as straightforward. The median home value is now around $485,000, slightly lower than last year. While some properties still sell quickly when priced correctly, speed alone does not necessarily mean buyers are competing aggressively. A fast sale can indicate strong demand, but it can also mean the seller adjusted expectations to match the market. That distinction is becoming more visible in Tacoma today. For many local households, approaching $500,000 remains a significant financial commitment. When you add mortgage rates, property taxes, insurance costs, maintenance expenses, and commuting considerations, the idea of Tacoma as a simple alternative to Seattle begins to lose strength. The age of the housing stock also plays a bigger role now. Older homes can offer charm and character, but they may also require substantial investment. Roof replacements, electrical updates, plumbing repairs, drainage work, foundation issues, heating system upgrades, and general upkeep are expenses buyers might have overlooked during the height of the market surge. Today, those potential costs are harder to ignore. In 2026, buyers are approaching decisions more carefully. They appreciate the neighborhood appeal and architectural style, but they also evaluate the full financial picture. Inspection reports are reviewed closely. Repair estimates are calculated. Monthly payments are compared with other available options. If the asking price does not align with the condition of the property, buyers are more willing to step back. Tacoma remains an important city in the region, but its housing market is no longer driven solely by the fact that Seattle is expensive. The market now has to justify itself based on its own fundamentals, and those fundamentals are becoming more demanding for sellers to meet. Number 7. Redmond, Oregon. Redmond's growth story is closely tied to Bend's rising prices. In simple terms, many buyers turned to Redmond because Bend became too expensive. That relationship explains the market better than anything else. For years, people who wanted to live in Central Oregon but could not justify Bend's higher costs began searching just a bit farther north. Redmond became the practical solution. It offered larger homes, more attainable price points, newer residential developments, convenient access to the regional airport, and proximity to the same outdoor attractions that make the area popular in the first place. In many ways, Redmond represented a compromise, close enough to enjoy the lifestyle people wanted, but far enough from the premium pricing that defined Bend. Because of that dynamic, it developed into one of Oregon's key secondary markets. Families were drawn there for space and affordability. Investors saw potential for growth. Buyers who were priced out of Bend viewed Redmond as a way to remain in Central Oregon without paying the full cost associated with the more expensive city. However, markets that grow through spillover demand often depend heavily on the performance of the primary city nearby. When Bend was rapidly increasing in value, Redmond benefited from that momentum. But when Bend begins to slow down, the effects quickly extend to surrounding areas. That pattern is now visible in 2026. Redmond's median home price is approximately $470,000, which is nearly 10% lower than it was the year before. Homes are still being sold, so the market is not stalled or inactive. However, transactions are occurring at reduced prices, with buyers acting more carefully and showing less urgency than during the boom period. That change in behavior signals a market adjustment rather than a dramatic collapse. The housing sector is not disappearing. It is recalibrating. Buyers are no longer accepting higher price levels simply because Redmond is cheaper than Bend. Instead, they are evaluating whether monthly payments make financial sense. They are reviewing local income levels, housing inventory, commuting distances, taxes, insurance costs, and whether delaying a purchase might lead to better opportunities or lower prices. That mindset shift is significant. During the housing surge, many buyers feared that postponing a purchase would result in even higher costs. Today, some believe waiting could actually work in their favor. For homeowners, that reversal changes expectations. A price drop close to 10% can significantly reduce equity, particularly for those who purchased near market highs. The rapid appreciation narrative that once supported confidence has weakened, and buyers are aware that they hold more negotiating power than before. Redmond still benefits from location, lifestyle access, and regional demand. Nevertheless, its recent correction highlights an important reality about spillover housing markets. When the main premium city cools, surrounding alternative markets can lose support quickly. Growth that depends heavily on proximity and affordability can reverse when the primary driver slows down. Number 6. Seattle. Seattle stands as one of the most influential housing markets in the United States because its growth was driven by far more than local demand. Its expansion was powered by global talent, high-paying technology jobs, major companies such as Amazon and Microsoft, startup culture, stock-based compensation, waterfront scenery, mountain access, limited land availability, and the widespread assumption that there would always be another well-funded buyer ready to step in. For many years, that assumption proved accurate. People would express frustration about rising prices, yet still proceed with purchases. Buyers would hesitate briefly, then return to the market. Sellers anticipated strong competition. Technology-driven income levels supported price points that would have strained or collapsed other regions. Seattle evolved into a city where the housing market depended not only on income levels but also on confidence. That confidence showed up in multiple ways. Confidence in employment stability, confidence in continued economic expansion, confidence in limited housing supply, and confidence that delaying a purchase would only make homeownership more difficult in the future. However, in 2026, that sense of certainty is no longer guaranteed. The median home price is now close to $865,000, slightly lower than it was the previous year. Properties are still being sold, but the urgency that characterized the most intense years has softened. Listings that once triggered immediate bidding wars now require discussion, evaluation, and negotiation. This change goes beyond price adjustments. It reflects a shift in mindset. During the boom, buyers were primarily motivated by fear of missing out. Today, many are more concerned about paying too much. That psychological transition influences the entire market. Although tech-driven wealth remains present, it feels less predictable than before. Concerns about layoffs, fluctuations in stock values, slower hiring cycles, return-to-office adjustments, and already high monthly housing payments are encouraging even well-paid households to proceed more cautiously. A person earning a substantial salary may still decide to wait. A family might look at homes farther from the city center. A tech employee could continue renting instead of purchasing. A remote worker may consider relocating to another state. An investor might determine that the expected returns no longer justify the level of risk. Seattle is no longer operating above the broader housing market cycle. Instead, it is increasingly influenced by the same economic forces affecting other cities. When expectations decline in a place that was built largely on strong expectations, the impact can feel more significant than the raw numbers alone might suggest. Number 5. Oregon City. Oregon City sits right on the edge of the Portland metro area, and that location has played a major role in shaping its housing market for a long time. As Portland grew more expensive, buyers naturally started looking outward. And when closer-in suburbs became more competitive and costly, Oregon City positioned itself as an alternative with a different kind of trade-off: more space, a sense of history, older residential areas, scenic river views, and prices that still felt more approachable compared to neighborhoods closer to the urban core. For a period, that balance worked in its favor. Buyers were willing to accept longer commutes because the perceived value was better. Sellers benefited as rising demand from Portland pushed interest outward. Homes with larger lots, established neighborhoods, and suburban access became part of what looked like a regional affordability pathway. However, by 2026, that pathway is becoming less stable. The median home price in Oregon City has dropped to around $546,600, which is more than 10% lower than the previous year. Properties are still being sold, which is an important detail. This is not a situation where demand has disappeared. Instead, it reflects a market where buyers remain active but are increasingly able to pressure sellers into lower prices. That distinction matters because it shows demand is still present, but pricing power has weakened. Buyers are still interested in Oregon City, but only at price points that match current affordability conditions. And those conditions have changed significantly. Today's payment reality is much tougher than before. A home priced near $500,000 on the outskirts of Portland is no longer automatically considered a bargain. Once you factor in mortgage rates, property taxes, insurance premiums, ongoing repairs, and commuting expenses, the overall cost becomes much harder to justify than it once seemed. The age of the housing stock adds another layer of complexity. Oregon City offers charm and character, but those qualities often come with maintenance responsibilities. Older homes may require roof replacements, system upgrades, plumbing and electrical work, window improvements, drainage fixes, and other repairs that buyers are now less willing to absorb without negotiating a lower price. During the market boom, buyers often accepted these imperfections because competition left them little choice. In 2026, the situation is different. Buyers are requesting credits, insisting on thorough inspections, and expecting prices to reflect the true condition of the property. Oregon City still holds strong appeal, but appeal alone is no longer enough to sustain previous price levels. Ultimately, the monthly payment has to make sense, and today's buyers are increasingly willing to wait until it does. Number 4. Boise. Boise became one of the most recognizable examples of the pandemic-era migration wave. It functioned as a kind of Western escape valve, offering an alternative to high-cost coastal cities. Compared to California, it was more affordable. Compared to Seattle, it felt quieter and less intense. Compared to Portland, it had more warmth and a different pace. At the same time, it still offered access to foothills, rivers, trails, and a strong outdoor lifestyle, while remaining large enough to feel like a proper city, but small enough to stay manageable. That combination triggered a major surge in demand. Remote workers arrived bringing big city salaries. Homeowners from California moved in with substantial equity. Retirees came seeking a slower, more relaxed lifestyle. Investors followed the migration trends, confident in the growth narrative and the steady inflow of new residents. For a period, Boise was widely viewed as one of the last genuinely affordable opportunities in the western United States. But eventually, that affordability began to fade. Home prices increased much faster than local wages. New housing developments expanded outward into surrounding areas. Investors competed heavily for properties. And gradually, the city that once represented a cheaper alternative started to feel expensive even to long-time residents. By 2026, this shift has become more obvious. The median home price is now close to $495,000, slightly lower than the previous year. Homes are still selling, but they are taking longer to move compared to the rapid pace seen during the peak boom period. This is not a sudden crash. Rather, it is a loss of momentum and urgency. Boise's rapid rise was built on several key assumptions: that out-of-state buyers would continue arriving at high levels, that remote work flexibility would remain widespread, that affordability would hold steady, and that prices would keep climbing because the migration trend seemed unstoppable. Today, those assumptions are being questioned. Buyers are beginning to ask more critical questions. How much of Boise's growth was driven by lasting demand? How much depended on cheap borrowing conditions? How much came from California equity flowing into the market? And how much was fueled by investors all chasing the same narrative at the same time? Despite these uncertainties, Boise remains an attractive city. The foothills still draw people in. The outdoor lifestyle remains a major advantage. The city still has strong long-term appeal and livability. However, a market can remain desirable while still being overpriced. A city can continue growing while also undergoing a correction. And a place can stay popular while buyers become unwilling to stretch their budgets further. That is why Boise ranks here. It illustrates what happens when a destination built on escape and affordability becomes so desirable that it gradually loses the very affordability that made it attractive in the first place. Number 3. Newcastle. Newcastle represents a very different kind of housing market warning. Unlike more affordable regions, this is a high-end suburban area located on Seattle's east side, near cities like Bellevue and Redmond. It is defined by hillside properties, strong household incomes, quiet residential streets, well-regarded schools, and close proximity to some of the most influential employment hubs in the region. For many years, Newcastle benefited directly from the broader east side economic engine. High-paying tech jobs supported steady demand. Growth in nearby Bellevue increased pressure across surrounding neighborhoods. Overflow demand from Seattle added additional momentum. Limited housing supply kept inventory tight, while the area's prestige allowed sellers to maintain firm pricing. In this market, buyers were not simply purchasing homes. They were paying for location, elevated views, school quality, commute convenience, neighborhood reputation, and access to the broader success story of Seattle's east side. Those factors combined to keep demand strong even at very high price levels. However, in 2026, even this segment of the market is beginning to show signs of resistance. The median home price in Newcastle is now around $1.54 million, which is nearly 10% lower than it was the previous year. Properties are still selling, but the sense of urgency that once defined transactions has clearly weakened. At this price level, a percentage drop is not just a statistic. It can represent a loss of well over $150,000 in value on a single property. That shift reflects real money moving out of the market rather than just minor price adjustments. The challenge in Newcastle is not about entry-level buyers being priced out. Instead, It is about high-income buyers becoming more cautious. When confidence in the tech sector softens, they pause. When stock portfolios fluctuate, they hesitate. When bonuses shrink or become less predictable, they delay decisions. And when they see comparable homes sitting longer than expected, they take notice. Luxury and upper-tier markets rarely decline in the same visible way as more affordable ones. Instead, they tend to cool more quietly. There are fewer emotional bidding wars, longer negotiation periods, more contingencies in contracts, and a growing number of sellers realizing that wealth does not guarantee constant urgency from buyers. Newcastle remains a highly desirable place to live, but desirability alone is not the same as strong pricing power. In 2026, it demonstrates a clear reality. Even affluent suburbs can lose momentum when prices rise beyond what buyers feel comfortable accepting. As soon as premium buyers begin negotiating instead of competing, the effects begin to ripple across the entire East Side housing market. Number 2. Olympia. Olympia has long been viewed as one of the more stable housing markets in Washington state. As the state capital, it benefits from a steady base of government employment, along with access to the broader South Sound region. The city also offers a mix of older residential neighborhoods, quiet suburban areas, colleges, parks, waterfront scenery, and a noticeably slower pace of life compared to nearby Seattle or Tacoma. For many years, this sense of stability helped support and protect the local housing market. Buyers who were priced out or frustrated with Seattle often looked south toward Olympia. Families sought more space and a calmer environment. Remote workers were drawn to its slower rhythm. Retirees appreciated the relaxed lifestyle. Meanwhile, investors valued the city's consistent employment base and the expectation of long-term, predictable demand. Unlike more competitive markets, Olympia did not rely on hype or rapid growth. Its appeal came from reliability and consistency. However, by 2026, even traditionally steady markets are beginning to feel pressure. The core issue is not that Olympia has become unattractive. It is that the cost of stability itself has risen significantly. Homes that once seemed reasonably priced compared to Seattle now carry monthly payments that feel heavy relative to local incomes. When mortgage rates, property taxes, insurance premiums, utility bills, maintenance expenses, and commuting costs are all considered together, affordability becomes much more strained. As a result, buyers in Olympia are becoming more cautious and deliberate in their decisions. Rather than rushing into purchases simply because the city feels safer than larger metro areas, buyers are taking their time. They are comparing multiple listings, monitoring price reductions, evaluating whether homes require repairs, and expanding their search into nearby areas such as Tumwater, Lacey, Tacoma, Centralia, and other smaller South Sound communities before committing. This behavioral shift is reshaping the market. When buyer urgency slows down, sellers lose some of their pricing leverage. Properties that once felt like safe, straightforward purchases now need to justify their asking price through condition, value, and monthly affordability. Olympia's situation is especially important because it is not a speculative or overheated market. It is a stability-driven one. And when even stable, government-supported capital regions begin to lose momentum, it signals that the broader slowdown in the Pacific Northwest is no longer limited to expensive tech hubs or lifestyle-driven cities. Instead, it is extending into areas that were previously considered the most secure. Number 1. Hazel, Washington. Hazeldale, often referred to as Hazel in this context, is located just north of Vancouver within the broader Clark County housing region. This area has long been shaped by spillover demand from Portland, relocation trends into Washington state, and years of steady price growth across the Pacific Northwest housing market. For a long time, Hazel had a very straightforward identity. It was considered a practical middle ground option. It sat close to both Vancouver and Portland, offered established suburban neighborhoods, older housing stock, everyday convenience, and a price level that felt more attainable than many surrounding areas. It was not positioned as a luxury destination or a high-end market. It was meant to be the sensible, affordable choice. That is exactly why the shift in 2026 stands out so sharply. The median home price has fallen to roughly $499,950 after dropping more than 23% compared to the previous year. Even though homes are still selling in less than a month on average, a decline of that magnitude is not typical market cooling. It represents a full reset in pricing expectations, especially for sellers. A drop like this can have serious consequences. It can erase years of accumulated equity, leave recent buyers underwater, force significant price reductions that would have been unthinkable during the boom, and turn what once felt like a safe financial investment into a stressful one. For buyers, the mindset has shifted just as dramatically. During the peak of the market, the main concern was how far above asking price they needed to go to win a home. Now, the dominant question is how much further prices might decline. That change alone weakens seller confidence and slows decision-making across the market. Hazel's vulnerability comes from its position as a value alternative within a much more expensive regional housing system. Buyers were drawn here because it felt like the affordable option. But value-based markets tend to become fragile when affordability expectations break and confidence begins to fade. When buyers believe prices are still falling, they delay purchases. When homes require repairs or updates, they expect deeper discounts. When better or safer alternatives appear nearby, they move on quickly. Despite this, Hazel remains a livable suburban community with access to employment, shopping, and both Vancouver and Portland. However, its housing market is now delivering one of the clearest warning signals in the entire region. This is no longer just a cooling cycle. In Hazel's case, the boom did not simply slow down, it reversed. And when a market that was built on affordability loses nearly a quarter of its value in a single year, that signal becomes impossible to ignore.